Welcome everyone to our Mortgage Choice Erina video series focusing on the Central Coast property market. As you can see on this chart here, we're focusing on rents or vacancy rates. Over the last 12 months, this has been a very strong focus in the national media. All capital city rents are going through the roof as increases in population outstrip the supply of property. This has created in Sydney a flight effect. Queensland, for example, has received 30,000 more New South Welshmen in the last 12 months. This is very close to an all-time record. Now, this chart here shows how the same thing is happening with the Central Coast. To just go back in time a little bit to this period through here, you can see that vacancy rates, which are the blue verticals, sat at around about 900 dwellings on the Central Coast were vacant. Then we had the global financial crisis and times got a bit tough and people were seeking cheaper housing. So you could see quite a dramatic shift of people to the Central Coast from Sydney. And that brought our vacancy rate to roughly 500 to 600 dwellings. Then you saw interest rates start to increase. Now, the Reserve Bank went through a steady process throughout this period of time of dropping interest rates. And this made Sydney a lot more affordable and meant people could live closer to work. So you saw people leaving the Central Coast and you saw less people moving to the Central Coast. Then COVID-19 smacked us in the face and there was lockdowns in Sydney and people moved for various reasons to places where they felt safer, and the Central Coast dropped down to lows of between 300 and 200. This is very close to full occupancy. It takes into account the fact that there's a lot of investment properties that might be undergoing renovations or might have temporary owner occupation for a short period of time, maybe uninhabitable properties. But you could say this is very close to full occupancy. Then you saw people having to go back to work. This may be employer driven, saying you need to come back to the office or the workplace, but you saw people starting to potentially see the realities of commuting to Sydney every day wasn't exactly what they were hoping for, and people started to move back. And we got up to a point where our vacancy rates were over 700 again. This did surprise me. It shouldn't have surprised me, but during this period of time, the Reserve Bank underwent an increase in their cash rate of 4%. And that got passed on to mortgage holders in Sydney, and life suddenly became very expensive. Landlords felt the pressure of higher interest rates on their mortgages. They passed it on to renters. Coupled with that, we had a big increase in population through migration, a lack of new housing supply being built in the construction industry. It's all led to this massive drop off to a point where we're below 1% of our properties are vacant again, and we're sitting back around that 300 mark, which, as I said earlier, is pretty much close to full occupancy. Now, what does increased demand and reduced supply do to prices? Well, this graph shows exactly what's happened to the Central Coast. You can see that throughout this period of time, you had increases in rents, but they were roughly in line with the CPI, the inflation rate. But then you saw this demand impact and lack of supply increase prices, particularly for houses. I think supply wasn't met by unit construction levels, but at least there was more units being constructed. Uh, that has largely been a result of these interest rates that have gone through the roof. You can see that 4% increase that I was talking to you about. This has made Sydney unaffordable and led to the increase in rents that we can see here and the reduction in vacancies that we can see back here. It's all related. The next video will cover off on the prices of houses and how all of this has impacted that. For first home buyers, this situation probably is starting to make you think it's better to buy. There are some very generous schemes out there that you can take advantage of. By all means, give us a call. For landlords, I think it's a case of looking long term. If you drive up your rents too high, are you going to be in a position where you're going to get more inconsistent tenancy? For potential landlords, could be a good time to buy, as I'm not sure if this demand is going to go away with the higher interest rate environment. And for people with existing mortgages, owner occupied, probably be glad that you are in a house, even though interest rates might be making things tougher. I think the best you can do with your situation is just make sure you're not paying too much interest. So again, by all means, give us a call, even if it's just to contact your existing bank and see if we can get you a better deal. We're more than happy to do that. Thanks very much for your time, and I'll speak to you at the next video.